Have you ever wondered what tax loss harvesting is and how investment losses could actually be a plus? A lot of people think they're locking in losses, but we're going to walk through examples today to show you why that's not the case. So stick around. Hello again, Chad Smith here, and I have brought in Allison Berger, one of my colleagues today. We're talking through an issue because a lot of people want to do things in this type of an environment. When they're feeling uncertain about their investments in their portfolio, they want to know what is it that they can do to make things better. And a lot of times that manifests in bad behavior, right? Wanting to sell investments when they're down because of fear. But there are some things that you can do that can actually help things in the future with your portfolio. And we're going to talk about one of those today that gets confused by the very name of it, because people feel like they're doing something that's a negative, but it actually is a positive, and that is tax loss harvesting. So I wanted Allison to provide a little color around what is tax loss harvesting and why it's important.
You know, I was just saying to Chad before this, tax loss harvesting always reminds me of classic Seinfeld episode. And he knows I'm always coming into his office and we talk about situations and I say, oh, there's a Seinfeld episode about that. And this always reminds me of the one where Kramer is talking about, oh, these big companies, they just write it off. And nobody knows exactly what that means. And that's pretty similar to tax loss harvesting. We find when we recommend that, a lot of people think, what is that? Why would I do that? Why would I sell something at a loss? So we'll talk about that in a little bit more detail today. And as Chad mentioned, you know, in a crisis like we're all living through right now, we feel that urge, like we really need to do something or I want to stop the bleeding. But in most cases, people take actions that end up being hazardous to their wealth. And tax loss harvesting is actually something positive that you can do to increase your after-tax wealth accumulation over time.
So what would you say then to the people, because we'll hear this comment sometimes, why would I want to lock in losses?
Yeah, so I think it can be helpful to kind of think about this as an exchange. And you can think about it as kind of like weeding the garden potentially. Or, you know, another way I'll look at it is I love to shop. So, you know, think about you buy something you really like, you buy a new shirt or a new dress and you pay full price for it. And then you go back into the store a month later and now it's 30% off. And you think, oh, shoot, I should have waited. You know, now it's a lower price, but I can't get that lower price. But with investments, luckily you can, you know, exchange that security for something else and get some tax savings out of that over the long run.
Right. So let's walk through a quick example of this.
So let's say, you know, last year, 2019 was a great year. In December, you decided it was a good time to get into the market. You bought $100,000 of SPY, which is a, you know, S&P 500 ETF. Mm-hmm. And, you know, unfortunately now it's down 30%. So it's only worth $70,000. Fortunately, what you can do is you can sell that position and exchange into something similar and take that $30,000 loss and write it off on your tax returns. So you can't write it off all in 1 year, but you can use it to offset gains up to that amount. And then any that's remaining, you get to carry it forward to future years and use $3,000 to offset your ordinary income every year. So that can be really valuable going forward, depending on what those losses are. You just want to make sure you reinvest in something that's not substantially identical. So we did an S&P 500 ETF. You don't want to go directly into an S&P 500 index fund. Just because it's a mutual fund, not an ETF, doesn't seem like that's different enough. So maybe you choose a large cap value fund, something similar that you expect to have similar returns going forward, but that's not substantially identical.
And is there a catch with it? Because it sounds like it's too good to be true.
Yeah, so the catch is there is something called the wash sale rule. And essentially what this rule means is you can't buy back the security within 30 days before or after. So this is not something that's for traders, essentially. You know, this is part of a long-term investment strategy. So you can't just rebuy the same security, sell it at a loss, rebuy it the next week, and take that loss on your tax return. So the IRS is going to disallow that loss.
So when you're making the transaction, you are selling at a loss, but you're reinvesting in a similar type of security so that it can then make gains in the future, continue to rise in the future, right? So then you have this, now you have this loss that you've realized. Mm-hmm. And I think it's important to talk about this now because you don't have these opportunities very often if you're investing for the long term, right? Because ideally your stocks are increasing over time and you'll have gains a lot of the time. Yeah. But when you get these opportunities So basically, when should you be looking to do this?
So bear markets are the best time to do this. Ideally you want to be doing it year round. So thinking about when you have dips and potential opportunities to do this, but the best time is in bear markets. And it can be really beneficial because, like we said, there's not always an opportunity to tax loss harvest every year. Most years the stock market is up. And actually what we're looking at right now for a lot of people, as I'm looking at their tax returns, is they had a really great year for investments in 2019. Maybe they sold some things at a gain and they're owing taxes right now because they didn't have any losses to offset those gains. And this is, hard pill to swallow right now when you're writing a check to the IRS and the State Department of Revenue when we're in this crisis that we're all experiencing right now. So having those losses that you harvested over different years in bear markets could potentially allow you to realize those and not pay as much tax on them.
So we talk about tax planning a lot on our podcast and through these videos and with clients. And this really comes back to tax planning specifically for your situation, right? Because you got to understand when is this and how do you know if this is right for you?
You want to look at your financial plan. I mean, this makes the most sense when your tax bracket right now is higher than you expect it to be in the future, so that you can, offset capital gains and income against high income, right, that you're experiencing right now. So it makes the most sense for high income taxpayers. Doesn't make a lot of sense if you're in the 10 or 12% bracket because capital gains are going to be taxed at 0% anyway. So it really doesn't make sense to realize losses if you're in those low brackets. So you want to think about that. Other things to think about, I think, are people who have large investments in one security. So say you have a lot of stock in the company that you work for, you have a single stock position for one reason or another. This is a great opportunity to look through. You probably have different positions that were purchased at different times over multiple years. Maybe some are at a gain, some are at a loss. This could be a good time to weed through and see what's at a loss. Can I realize gains on some of the positions and offset those taxable gains with a loss on other positions? So this is a great opportunity to reduce an over allocation to maybe an individual security, which we've talked about a lot, how that can be very risky. So if you have, an outsized position in an individual stock that tends to be that is at a large loss right now, this could be a good opportunity to realize those losses, have them be able to carry forward, and then realize gains at low rates later, diversify that position. So it's really good opportunity to diversify and then to look through your portfolio and see, am I still holding some stuff that doesn't make sense anymore? A lot of clients come to us with portfolios of really high cost mutual funds that they purchased a long time ago. So this could be a really good time to sell out of high cost securities and get into something low cost that better meets your needs over the long term.
Great ideas there to consider in your situation and to look through. We're happy to provide those and others through our podcast and through these videos. We also have a detailed article on our website, financialsymmetry.com, that you can look through that we'll link below in the description. And feel free to share this with others and subscribe if you don't want to miss our next video.